Yeah, heading towards 3,000 pretty fast, and it's a cyclical rally by and large. Take a look here what's going on. So we have semiconductors up nicely today. That's Apple helping things out. Retail, metals and mining stocks, banks, these are all cyclicals here. And, of course, defensive names like utilities are lagging. That's a pretty good sign overall. Just let me show you Apple and the Apple suppliers because he's right. We're right near a 52-week high. Not there yet, but near a 52-week high on Apple. And here's some of the Apple suppliers that are all up nicely. Of course, comments from Tim Cook that the new iPhone 11 sales off to a very strong start. Those are his words here, all helping the market overall. So we're starting October. The problem with right now is we're kind of in a wishy-washy middle phase. There's nothing really tremendously oversold or overbought. If you take a look at some of the things, utilities have had an amazing month in September. They're a bit on the overbought side. Oversold, not a lot. I see metals and mining have been sold rather aggressively going into the end of September. Biotech was sold rather aggressively. And some of the recent IPOs, we've covered that one pretty well. Let me just show you what happened in September for some of the IPOs that have happened in the last 3 or 4 months. So CrowdStrike, PagerDuty, Chewy, Pinterest, all had terrible months. Most of these 20% or more declines happened in the last 2 weeks of the year. The IPO ETF, as we mentioned, moved down to the lowest level since February there. I thought it was very amusing. You could tell the venture capitalist market is kind of concerned about how IPOs have been doing. There's been reports that some of the venture capitalists have been trying to convince people over in California who are considering IPOs to use direct listings. This is an interesting idea. I agree the cost of IPOs is high. It could be 4 to 7% of the proceeds. The results can be uneven. It can be annoying and disappointing. But just point out here that any kind of direct listing does not guarantee that anything nice is going to happen. If you look at Spotify, remember the reference price that we used? It's not a price. They use a reference price, was $132. Now we're looking at, what, $114? So that's not up. If the other one that was a direct listing was Slack, and that was $26. That was the reference price that was used there. Slack's now at $23. So I certainly agree. Alternatively, you can use a direct listing, but you're not raising money, and there is no guarantee that that's going to perform any better for the company overall. Let's talk about what happened with the e-brokers. Jim mentioned this very briefly. This is a rather surprising outcome if you consider what really goes on, how these companies really make money. So Schwab is eliminating commissions for stocks and ETFs, but look at how these companies actually make money. Schwab is essentially a bank. Take a look here. It gets almost all of its revenues from net interest revenue, 57%. It's a bank. Asset management is 32%. Trading revenues is only 8% of the company's revenues. In other words, the company can essentially afford to drop some money on trading revenues, providing it keeps its customers and its continuing ability to scale up. Now, there is a lot of competition out there, not necessarily from the e-brokers. There's other people that are poaching the territory. J.P. Morgan's got You Invest out there, these low-cost brokerage firms. We've got Bank of America with low-cost brokerage. Robinhood is out there. We know all sorts of competition that's out there. It's not dramatically eating into the e-brokers yet, but the key thing here is keep the customers in-house. Schwab's been very successful with their ETF platform. They're now one of the big 5. That's been working. So don't lose the customers, even if you have to cut the prices. That's the key right now.